Okay, so it looks like we've got quite a few in attendance, so I think we can go ahead and get started. I'm pretty sure everybody here knows who I am, but for those who don't, I'm Sarah. I'm the Chief Operations Officer here at Wealth Plan. Today we have Ben Birken. It's Birkin, like the bag, right?
Correct.
The bag. Okay. We have Ben with us today, and we're going to go over some tax planning. Just kind of felt like the time was right. No one can give a better intro than themselves, so I'll kind of let you kick that off, Ben, and kind of go through your background and what brought us here today.
Sure, happy to. My name's Ben Birken. I am here with two hats on. So, the primary hat is as the Vice President for Customer Success and Engagement with Holistiplan. This is our tax planning software, came online 2019 and has just exploded in growth since then. I think we actually just crossed 25,000 users earlier this week, which is kind of crazy when you think about, you know, being around for just over 4 years and hitting 25,000 users. But uh, my second role, I'm still a practicing advisor. So I have an RIA. I've been a practicing advisor for over 15 years now. So started in, my goodness, over 16 years, started in 2007. Own my own RIA where I still work with about nine or so clients. I was at a larger or mid-sized RIA here in Chapel Hill, North Carolina, before leaving there to start my own firm and then working with Holistiplan at the same time.
Awesome. Well, before we really, I mean, obviously, we partnered with Holistiplan about a month ago. Several of our advisors had, requested interest or kind of contracted with them themselves, and we thought it was worth kind of adding to our firm level tech stack. So we do have advisors today that are familiar with the platform and have already used it, and then others that are just kind of getting into it. Um, our tech's all optional, so we could potentially have some guys on here as well that didn't opt in, but still have the opportunity to. But before we really get into kind of the graphs and charts and all of that, can you just share a little bit, especially having that advisor side yourself, how this topic has become such important in your own business?
Absolutely. As a certified financial planner, as somebody came up through the comprehensive financial planning sort of education, you can't run away from taxes when you're talking with clients. I mean, you can, but we always say that taxes are like the ivy in the financial planning process. It grows everywhere, right? It touches everything in some way. It touches cash flow, obviously. It touches retirement planning. It touches investments. It can touch estate planning if you have super wealthy clients. It always makes its way in, and usually never in a good way, right? Nobody really starts talking about like, yeah, taxes this is amazing, taxes. But to the extent that you can help clients, not always like save them money in taxes. That's not, I think, a realistic goal to say like, yeah, we're going to save everybody money in taxes. But even if you're just explaining how taxes work, that is a huge value add that you can do for clients. Because you think about your tax return. Um, this is not a well-designed document, right? It is confusing. The instructions are terrible. It is long. Uh, it incomplete. So just as an example, we're familiar as advisors with the concept of your marginal tax bracket. Where does that show up on your tax return? Well, nowhere, right? It's actually not even a number that shows up on the return. And yet, we expect clients to understand that concept. If you make a mistake, it can be really expensive and there can be legal situations going on. And for many of your clients, their tax bill is the largest expense that they pay, right? So, how can you avoid talking about taxes? Just explaining them, but then taking that next step of saying, yes, I can explain how taxes work. But now that we know how they work, how can we use those components to at least give you a more optimal outcome? I can't take your tax bill down to zero every year. And maybe I shouldn't always want to do that as an option anyway. But at a minimum, I should say, let's not pay a dollar more than we have to. And let's be strategic about the taxes that we have to incur. Maybe it's okay to pay a little bit now to avoid paying a little bit later. And so that was something that's always of interest to me. There just aren't very many good tools out there to help financial advisors do that. CPAs have all of the tax software, which is really good about looking backwards and making sure from a compliance point of view, did every number get on the form the exact right way so that nobody's going to jail because we're submitting something that's fraudulent. That's the primary job of a tax preparer. And that's not meant to be disrespectful to the CPA. They're fantastic at what they do. But it is rare to find CPAs. It's becoming more prevalent, but it's rare to find CPAs who are as equally interested about next year as they were about last year. And that's where the financial planner comes in, the financial advisor comes in, because the advisor has this, if they're doing their job well, this full picture of a client's financial picture, like everything, right? Bank account, investment accounts, retirement plan, like you see the whole thing. You probably should have some sort of insight into, if we do this, then X is going to happen from a tax planning perspective, and that's not good, right? So how can we then develop those tools to help folks with that? And that's where the Holistiplan really came in. When Holistiplan came to market, there were a few like projection tools. They're relatively either not very well known, or they're really, really complicated, right? They're hyper complicated and in a way that doesn't really fit what I'll make up a number, and they're like 95% of client situations. So enter Holistiplan, which allows at a bare minimum, like two things. One, all you have to do is upload a client's tax return
Mhm.
to the software. Software reads through it and then puts out a report to you, the advisor, you can share with the client that does a high level summary, but then also gives you actionable observations about, hey, this is what happened last year. If last year and this year look even kind of sort of the same, we should think about this. We should think about that. Right. For folks who are doing reviews of tax returns, might have already been doing this on a manual process. That's what I was doing. And in fact, I'm friends with the two founders. We kind of compared notes and said, okay, you're using this really long checklist to go through somebody's tax return. I'm using this really long checklist to go through somebody's tax return. This is kind of silly, right? This is what computers are for. Tell the computer what to look for, and it'll look for it. And that's kind of how Holistic Plan came to be. So that's one really incredible component of it. But then the second component is also, okay, that's really helpful for last year, but now I want to know about this year. And that's kind of the stuff that we're going to be talking about today, right? So year-end tax planning, how can I use tools to help me better formulate some of the ideas that I have in my head about year-end tax planning and turn them into actionable things that I can tell my client, if we do X, then Y is probably going to happen. That's enormously valuable. It was valuable when I was working with over 100 households. It's valuable when I'm working with 9 households. It is valuable to the 25,000 users that are working with hundreds of thousands of households. And hopefully it's going to be that much more valuable to the folks at WealthPlan Group for the clients that you all serve.
Yeah, absolutely. Just to save the time and have that security around knowing that there's a professional algorithm behind that looking for those items.
And I'll say too, sometimes people get concerned. Your goal is not to replace your client's CPA, right? Your goal is not to prepare taxes. Your goal is to have a better educated conversation with your client, and ideally they're tax professionals, so everybody's on the same page about, hey, I'm thinking about this. Here's what I see. What am I missing? Can we talk about this together? And that's really where you get the optimal experience with the client's outcomes at heart.
Absolutely. Well, let's go ahead and jump into the deck. We will have a Q&A at the end, so just drop any questions that you guys have for Ben or myself into the chat, and we will set aside a few minutes at the end to make sure we get those covered.
Wonderful. Thank you, Sarah. So obviously we're here to talk about year-end tax planning. I'm Ben Birken. We've already covered that part. So let's just jump to slide number 2. We're going to look at a few different charts here, not so much holistic plan specific, but more here's what the industry is saying and here's where the industry is going. So there's a couple of different surveys that we're going to highlight. One is from the Spectrum Group. This is from 2021, where they did a comparison. They asked a whole bunch of client of wealth management firms, what are the services that you expect? And what are the services that you receive? And we're not going to talk about every single one that's on here, but I will highlight, because we're talking about holistic plan and tax planning. Here's this one right in the middle. 92% of clients in this survey expected tax planning services, not tax preparation, tax planning services. And how many were getting it? 25%. That's a huge value gap, right? That's a huge service addition that people can bring to whatever they're already doing for clients, because clients want it, right? And at least a couple of years ago, very few in this particular survey were offering it. We're going to look at something similar. This is Angie Hebers. For those who are not familiar with her, she's a very prominent practice management consultant, and she ran a survey. I believe this was last year. It was either last year or this year, but looking at something comparable. Um, you know, Looking at the most in-demand service for consumers with more than $250,000 in assets, and the number one thing that they wanted was tax planning. Now here we see a little bit more of a change, right, from the Spectrum Group. Before it was only, 25%, now 73% of financial advisory firms are offering it, but still, right, that means that there's 25% that still aren't. I don't think you want to be in that 25%, right? You want to be in that group that is offering this because A, it's valuable to clients and outcomes, but B, like clients want this and they expect this. So it becomes more a matter of if this is something that clients want and something that we want to offer, how do we find the right tools to do it? Wealth plan thinks Holistic Plan is a way to do it. So does the industry. So this is the Michael Kitces survey from earlier this year, just showing it's kind of a complicated chart is what we would expect from a thought leader like Michael. But what we're looking at on the y-axis is the importance. So these are financial advisors or the survey respondents here. How important is this piece of software? And then on the x-axis is the adoption rate, and we see tax planning is in that section that is both up and to the right. So it is high importance, and we're seeing greater and greater adoption. Specifically, and this is going to be one of the few places where I brag, Holistiplan received the highest satisfaction score of any provider type across the entire study. So not just within tax planning, but across the entire study. So, we hope that we can deliver on that promise and that experience that other folks are having for the folks at Wealth Plan Group as well. Today, what we wanted to talk about was more fourth quarter or year-end tax planning topics. And where I pulled from was a study that we did internally at Holistiplan a couple of years ago, where we said, what are the sorts of things that you're doing from a tax planning perspective in each quarter, Q1, Q2, Q3, Q4? And we just asked folks like, hey, what are you doing in this quarter? And what we saw were that the majority of tax planning things that people did actually happened in the fourth quarter. So high bump in the first quarter, second and third quarter, things kind of smoothed out a little bit. And then in the fourth quarter is when people were doing the majority of their tax planning things. And when we broke those tasks into categories, there were two ones that stood out. The ones that had to be completed by December 31st, right? Because that calendar flips from 2023 to 2024, and the books are closed, and you can't do anything else for December 31st. We got to talk about those. Those are the most important ones. But then the second category, which I don't know that we'll talk about as much today, but gets into like, hey, what are the things that you can actually be doing this year in anticipation of next year already, right? Teeing things up for a smooth 2024. There are probably more things that folks are talking about for year-end tax planning as we get to than are on this slide, but these are the ones that stood out. And I further broke this down for things on the left and things on the right in terms of maybe importance, but also the stuff that we get asked about most inside Holistic Plan in terms of, well, how do I show clients this, right? How do I model these certain things? So that's why we have on the left things like Roth conversions and charitable contributions. Those two topics comprise the majority of questions that we get at Holistic Plan for how do I model this inside of our scenario analysis, which is our projection tool. And even within charity, right, two different things: qualified charitable distributions and donor advised funds, particularly in terms of year end stuff for people who've never done a donor advised fund before. You can't just decide to do it on December 27th, right? There's just not enough time to get the thing set up and then funded to make sure you get it in for this calendar year. But we'll talk through all that in a little bit more detail. The third
Ben,
thing
do
would be
you have checklists that we could provide our advisors that want to kind of go more in depth on these items to make sure that they're having these conversations before these deadlines?
Um, I don't know that we have a specific checklist for these particular things, but let me put that back to you, Sarah. Like, what would that checklist look like? Do you think?
Well, I mean, to your point, everything is very time sensitive, right?
Mm,
There's things that if you don't get done before year end, you've missed that opportunity. And I think beyond Holistiplan or kind of the items you're listing here, the charity contributions and things like that, kind of creating a timeline to ensure that
mm.
we're touching these items in a timeline that makes sense.
I see what you're saying. Yeah. So I don't know that we have a specific checklist to that. I will tell you that mentally these things exist in my head, and the reason I say we don't have a checklist is because some of these things end up being very custodian specific, right? So
Mhm.
I custody with Schwab now. I used to custody with TD Ameritrade, but now I
We're
custody
on
with
we're
Schwab,
on that same ship. So
and what a ship it is. But, I think intuitively, as an advisor, you have to think if I'm thinking about this, other advisors are probably thinking about this too. And in fact, I know TD Ameritrade to do this. I'm pretty sure Schwab, I have to assume Fidelity, every major custodian is going to start coming out to you with a, hey, If you haven't done this yet, here's our drop deadline where if you get it in before this, it's gonna happen.
Mhm.
Probably gonna be early to mid-December. If you get it in after early mid to mid-December, we're gonna do our best, right? It becomes a we'll do it to a best efforts. I will tell you mine. This won't be Holistiplan's philosophy, but I will tell you mine as a planner. I want to have all this done before December. I want to have my clients' required minimum distributions done before Thanksgiving. Right now, I'm lucky. I only have 9 people, and not all of them are retired. But these conversations need to be started before November. Ideally, you're having these conversations with people all throughout the year, but if you're just bringing it up, you probably need to have this conversation now so
Mhm.
that your clients have time to digest the information and so that anything you do is done. Again, this is just me talking by
Mhm.
December 1st, so that if something goes wrong, built in a buffer time, right? So somebody forgets to sign their Roth conversion form. Well, you don't want that going out on December 29th because it's not going to get processed in a timely fashion.
Right. Do
Same
you
thing.
find it harder to get a hold of clients in the month of December as well?
Well, um, I'll use this, I'll switch it around. Are you harder to get a hold of in the month of December for the people that want your attention? Of course you are, right? We're thinking about time off. There are fewer days that we're actually in the office. If you have children, they're not in school starting, that third to last week of December. So, attention disappears, right? It slowly disappears. And then it'll come back, right? It'll come back in January, but by then you're kind of done, right? So
Mhm.
these conversations need to start now, right? And I would say, even though we're already in October, once you are in the process of this, you start realizing I need to prime my clients to have these conversations by talking about it all throughout the year. Right. So this is actually part of a larger presentation that we do called Tax Planning is a Year-Round Sport, which is something we can come back and talk to y'all about. So we can actually look through not just the Q4 stuff, which is timely now, but
Mhm.
how do we think about a tax planning service offering all throughout the year? What are the things we want to be thinking about in Q1, Q2, Q3, Q4? So I would love for that to be something that we revisit, maybe early part of next year. We can come back and do that whole presentation so we can break down. That's really more of the timeline sort of thing. Here's what we're doing in Q1. Here's what we're doing in Q2, Q3, Q4. Is that
Yeah,
fl-
absolutely. I think that that's a great resource that maybe we can partner and put together at a later date as well. So thank you.
absolutely sure? The third one that's on here, portfolio based activities, a couple of different things on here. One, some of this will be um, investing philosophy specific, right? If you only use individual stocks and maybe some exchange traded funds, you don't have to worry about mutual fund distributions. But if you use mutual funds, even some index funds, you do have to be aware that they will be distributing dividends before the end of the year that you can't control. But if you're using actively managed mutual funds or even index funds that are doing trading throughout the year, those distributions are going to be passed on through to the shareholders. That can sometimes be a big surprise to people to say, "Well, you didn't trade anything for me, and yet I'm having to pay, there's a $10,000 capital gain. I don't understand what's going on there," right? So that's something we need to be aware of. But beyond that stuff that is within our control, the concept of both loss harvesting, which I think most people are familiar with, right? You sell something for less than you paid for it, you can use that loss to offset gains. If there's more loss than gains, you can use it to offset income and so on and so forth and to carry forward. But one that people sometimes tend to forget is the concept of gain harvesting, right? Where you're actually realizing gains strategically because your client's income might be low enough that they fit in a 0% bracket for long-term capital gains. That's free money at the federal level with a resetting of cost basis, right? So that's something that again, time is time dependent. We want to spend a little bit of time talking about that today. On the right-hand side, stuff again that does need to happen by the end of the year. So if your clients are trying to max out certain accounts, right? We got to hit that maximum contribution amount by December 31st. 401k, 403b, 457, 529 plans for those states that offer a tax break, a tax deduction for 529 plans, right? That has to be in by December 31st. Flexible spending accounts, right? So if you've encouraged clients to use FSAs to get pre-tax spending for certain things, for dependent care, for health-related things, you got to empty that out. There's a little bit of a grace period, I think, on health-related things, but ideally, we're targeting the end of the year to use up all of that stuff. Withholding on end of year distributions, primarily targeted towards people taking money out of retirement accounts. but also an opportunity to true up. Are you on track to hit your safe harbor amount? Right? So safe harbor being the minimum amount that somebody has to pay into taxes, either through withholding or estimated payments, so that they're not assessed an underpayment penalty. For folks with consistent income, it's probably not that big of a deal. But for folks with lumpy income, your entrepreneurs or folks that have equity compensation like stock options or restricted stock units where the withholding is never really what we want it to be, have we done that projection to make sure that they're not going to be hit with a surprise bill of like, oh, you need to write a check for $30,000. That's bad enough. But on top of that, you owe another $2,000 because we didn't pay in enough and you're hit with an underpayment and penalty, right? So are we getting close to what our clients, if not their anticipated tax bill, but enough to prevent them from having to pay any penalties or things like that? And then the last one, this concept of we want to push taxes off as far as possible. That's not always true, but primarily thinking about here, business expenses. Can we bring deductions into this year and push income into next year? Um, One tip on that, Sarah, and this is not related to business folks, but I happen to work in a university town, so a lot of professors, academics, um, who don't ever retire. They kind of work forever. But the university here, you get paid out for your vacation days, right? So I don't know if this is consistent with some of the folks and the employers that you all work with, but we always try to encourage people, don't retire in December. If you can, retire in January. Why? Well, if you retire in December, you got a full year of income, and then you're gonna get paid out for your vacation days on top of that, where you're gonna get hit with, whatever your marginal rate is. Well, if you're gonna be retired next year and your income's much lower, can you maybe retire mid-January and get paid out there, right? So we bring that income potentially at a lower tax rate. So, this concept of can we shift income around? You can't always do it, but if you can, that would, right? So today we're gonna talk about the stuff on the left-hand side of this screen. Um, you know, Big picture, some Roth conversion type considerations. I'm going to make the assumption that most folks are pretty familiar with the concept of a Roth conversion, but high level, taking money out of a traditional IRA, converting it into a Roth IRA. That's a taxable event. Pay taxes on that distribution. Why might you do that? If you believe in the concept of the government's always going to get its money, which is a pretty good assumption to make, sometimes we have control over when the government gets its money and sometimes we don't. With IRAs, we sometimes do. So if we believe at some point we're going to have to take money out of a traditional IRA, either because we need the money or we're forced to because of required minimum distributions, there might be years where your income is artificially lower than it will be when you take the money out. And this is our opportunity to take advantage of that. So we're going to take money out of the traditional IRA, pay taxes on it now, so that we get into this tax-free bucket where we don't have to worry about paying taxes on any withdrawals ever again. We also don't need to worry about minimum required distributions out of the Roth IRA like the traditional IRA. So when does it make sense? Well, whenever we think that rates now are going to be lower than they might be for the same client in the future. That is independent, but somewhat related to the concept of where our tax brackets are right now. So in a couple of years, if nothing happens, this current tax regime that we're operating under, that we've all become accustomed to, is going to disappear. And we're going to go back to the way things were in 2016, when there were higher brackets and when there were lower standard deductions and when personal exemptions were a thing. And when if you made too much money, you started phasing out of your itemized deductions and personal exemptions and a whole slew of stuff that we've kind of forgotten, except it's kind of like sitting there in the back of our minds, like it used to be with like practicing the piano. Like you thought about like, yeah, I kind of have to do that, but I don't really want to. Same sort of thing with, the sunsetting of the Tax Cuts and Jobs Act. It's on track to happen. Now, whether it does happen or not, who knows? A lot can happen in 3 years, but we wanna be aware of the rate that we have right now are not set in stone forever. And if we can take advantage of a 10% or a 12% marginal bracket, that might be a really good idea. Keeping an eye on the market. The first half of this year wasn't really that helpful from the I mean, it was helpful for clients' accounts, but it wasn't helpful from a tax planning point of view. When markets are going up, people feel really good about that. But last year, and maybe the last 3 months of this year, down markets present tax planning opportunities as they relate to Roth conversions, because you can put the same asset now inside of a Roth and experience eventual growth on it in a tax-free regime as opposed to just a tax-deferred regime. And that ties into this last bullet point here, the concept of starting tax-free growth now versus maintaining tax-deferred growth. Why do we put this in the Q4 bucket? Well, part of the Tax Cuts and Jobs Act situation eliminated our ability to recharacterize conversions, right? You used to be able to say, I did a conversion. Oh, I don't like the way that happens. I'm going to recharacterize. I'm going to take it back. Well, you can't do that anymore. So we need to be more mindful about our clients' income picture over the course of the year if we're going to be strategic and targeted in terms of our total Roth conversion amount. What we've seen some folks do is do a little bit in Q1 or Q2 and then do a true up in Q4 when we've got a known dollar amount of, hey, here's what we think our total income is going to be. If our goal is to stay within a certain tax bracket, now we know exactly how much of a conversion we need to do to not go over. Uh, will also impact not just the marginal rate that somebody is subject to, but also being mindful of Medicare related surcharges, right? Income related surcharges, where if you go over a certain dollar amount of income, not only do you have to pay tax on it, but you are now looking at a higher Medicare bill 2 years from now because of the way that the Medicare look back works, right? We'll jump into Holistiplan in just a second, but I wanted to walk through kind of these things and considerations for both the Roth conversion and then the QCD and the donor advised fund first, if that's okay. Um, so the second item that we talked about was a charitable giving. We broke out two concepts, both a QCD or qualified charitable distribution, and then the concept of a donor advised fund, which we'll talk about next. So qualified charitable distributions, these are distributions from an IRA directly to a charity where that distribution doesn't show up on a client's tax return. Because it's going to a charity, it doesn't show up on Schedule A as an itemized deduction since it never counted as income in the first place. But you also can use that QCD to accomplish some portion of your required minimum distribution, right? So it counts against your RMD. You can only do it when you've turned 70 and a half. So I remember thinking when I first learned about this, oh, wait, I can send money out of my IRA for a charitable situation. That sounds great. And then I realized I have some time before I'm allowed to do that. So it's not going to be on my timeline anytime soon. But for clients who are over 70 and a half, they are allowed to do this up to $100,000 every year. Does it mean that it always makes sense? Well, it kind of depends on your definition of always, right? If your clients are not charitably inclined, this is probably not something that's worth bringing to their attention. But if they are charitably inclined, particularly in this world where the standard deduction is so high, and it's pretty challenging for somebody in retirement to hit, especially a married filing joint couple, that higher standard deduction when you also have the age 65 additions to it. You're looking at a standard deduction of almost like $30,000. That's hard to get to from an itemized deduction point of view. Most folks aren't carrying a mortgage balance into retirement. Maybe they are, but it's probably, hopefully, at the end of that. Um, maybe there's like medical deductions. Maybe they're hitting the $10,000 of state and local tax. But still, like that's a pretty high difference between where they might be and where they have to get over. Because when we think about this, and I think this is something that most lay people don't realize, if you're only taking the standard deduction and you're still giving to charity, your charitable gift has no taxable impact. It has the same impact as if you were giving nothing. It's only the next dollar above the standard deduction that really is taxable or tax efficient, right? So if I'm giving $5,000 every year and I'm taking the standard deduction, it's nice. It feels really good. But from a tax point of view, it's the same as giving nothing. So the QCD in its way is a way of almost giving like a 100% tax deductible gift because it's not showing up as income. So I would say like for many people with these lower standard deductions, they probably make a lot of sense. Unfortunately, or fortunately, depending on your point of view, the timing between when people can start doing QCDs and when required minimum distributions start has now separated from itself, right? It used to be the same, 70 and a half for both. Now we're looking at some folks who don't have to take their RMDs potentially until like age 76 because of the Secure 1.0 and 2.0 acts. Doesn't mean you shouldn't still do it. It just means it doesn't necessarily help with required minimum distributions. But what it can do is if you're in that window where you're not yet taking RMDs, but you still want to give charitable gifts, that can help reduce future required minimum distributions because you're reducing the balance of the IRA. So just because it's not offsetting your RMD doesn't make it bad. It just loses a little bit of power. But when you are offsetting your RMD, then this other slew of things in this third bullet point come into play, right? Because you're doing this QCD where the distribution never shows up on your return, it's never going to get into your adjusted gross income or your AGI, which potentially lowers the threshold for things like deductible medical expenses, right? Because those deductible medical expenses, they're at a percentage of adjusted gross income. So if we can lower that, maybe we can sneak a few more medical expenses into the deductible field if we're otherwise itemizing. What else can we do? Well, maybe we're offsetting Medicare premium surcharges. Maybe we're reducing your net investment income tax. So there's a lot of different things that a QCD can be helpful with, right? Sarah, I'm going to turn this back to you just as a question. Do you see a lot of chatter within Wealth Plan Group about like our clients asking about things like qualified charitable distributions? Is this something that Wealth Plan Group talks to clients often about, not just at the end of the year, but maybe all throughout the year?
Yeah, I mean, I definitely think that there's a value add there. I do think that we have a lot. I mean, we have a lot of high net worth clients, and the charitable giving is an easy way to alleviate some of that tax burden. To your point, in a way that can make you feel good. So definitely, a lot of charitable giving accounts, a lot of inquiry on how to best do that for our clients.
So I think what you mentioned there is how do we best do that, right? Because there are multiple
Mhm.
ways to give to charity. This can be a really good tax efficient way, but it's not for everybody, right? Like it wasn't for me, thankfully, for another, I won't say how many decades, but like this is not something that is a strategy for me. But that doesn't mean that there aren't any strategies available as it relates to charitable gifting for people to try to take advantage of the way that the tax code works. So one of them, it's conceptually the slide says donor advised fund, but we need to take a step back from that. When the standard deduction jumped, from 12,000 to whatever it jumped to with the Tax Cuts and Jobs Act, basically doubled. It made it harder for a lot of people to itemize, right? It just did. That didn't make it impossible, but it made it harder. And what you started to see was this emergence of this strategy of, well, are there things that we can bunch together in a single year that might otherwise have been strewn out over, a couple years? And charitable giving is an easier one to think about, right? You can't bunch together. I mean, you really can't bunch together, your state and local taxes. You can try, but you're still capped at $10,000 each year, right? That's the most that you can deduct. Um, you can't prepay your mortgage interest. You can pay down your principal, but you can't prepay your interest. And all of a sudden, you're like, oh, I don't really have any more. Um, uh, oh, what's the word I'm looking for? Optional deduction things, except for charitable giving, right? You can hypothetically say, I'm in the habit of giving $5,000 per year. If I have the ability to do so, maybe I give $15,000 this year, which is my gifting amount over the next 3 years, and then I don't do any gifting in years 2 and 3. That might be more strategic, more advantageous for me over a 3-year time frame as far as taxes are concerned. So it's really just this the donor advised fund is just one way of doing this bunching strategy. But it's doing it in a way that I think maybe fits with how many people think about how they want to do their charitable giving. So big picture, how does a donor advised fund work? You as the donor give assets, you donate assets, can be cash, could be appreciated securities, could be complex assets like land or business interests in some cases to a donor advised fund. The donor advised fund is a 501(c)(3) public charity. So that's actually your charitable gift. You get your letter of here's how much you donated to the donor advised fund, and there you go. But then out of that donor advised fund, you can recommend smaller dollar grants pretty much to any other public charity. So it's a much more efficient way of giving large dollar amounts in a single year where you might not otherwise have said, I don't know if I want to give $15,000 to the United Way. Maybe not this year. Maybe I want to spread it out some. Maybe I don't know who I want to give this to. I just know I want to do something with it. So it is a way of taking advantage of a tax deduction in one year, but then maybe spreading out the actual gifting of those assets to the ultimate recipient charities over a longer time frame. A couple of other things just related to donor advised funds. They're administratively easier. When I say that, I mean, if you're giving in writing, 10 $100 checks to charities, that's 10 letters that you need to um, put together and ultimately give to your CPA. Here you just get one, right? You're just getting it from the donor advised fund. Again, you can donate complex assets. You can donate appreciated stock, but make smaller grants. So as an example, my son plays Little League. He loves Little League. the Little League always needs money, and buying, hundreds of pieces of Bazooka Joe bubblegum is not going to do it. But I also don't want to donate like one share of the iShares S&P 500 ETF to the poor treasurer who's got like a real day job at the Little League. Like that doesn't make it easier for anybody. But I can donate that stock to my donor advised fund and then have the donor advised fund make $100 gift out to the Little League, and then everybody's happy. Some donor advised funds allow you to gift anonymously, so you're not on that list that, all of a sudden everybody's hitting you up for money. So that's something that is a really nice feature, and then allows for a potential legacy. You don't have to, your donor advised fund doesn't necessarily have to end when your life ends. You can bring your children into it, name successor grantees. So, there's a lot of different things that you can do with this. And again, Sarah, I'm going to ask you, is this something that Wealth Plan Group talks to folks about? Is this something that is becoming more or less prevalent in some of the work that you're seeing people do?
Yeah, I mean, I think so. We definitely have a lot of clients that kind of do have that legacy, contributions that they want to make. We definitely have clients that are very particular about what charity they're giving to, right? They have very specific charities that they're very passionate about. And I think sometimes our advisors may run into issues on, how to make sure that they're hitting those charities that are important to the clients
Mhm.
and still allowing for these, same tax advantages. So for Q4 purposes, is there any timing considerations you'd recommend for advisors to be aware of when it comes to that?
Absolutely. So similar to any sort of processing that they're doing with distributions out of a retirement account, right? So setting up a donor advised fund, depending on where you're setting it up, sometimes it can be quick, sometimes it might take a little bit of time. Um, Fidelity, Schwab, Vanguard all offer donor advised funds. Some community foundations offer donor advised funds. Some independent donor advised funds offer donor advised funds. So timing's kind of important here. So you want to make sure you're not behind the eight ball. But more importantly, getting assets out of somebody's brokerage account and into that donor advised fund doesn't happen instantaneously. It can, it's like if you custody at Fidelity and you use Fidelity's donor advised fund, guess what? That's pretty quick. But if you custody at Schwab and you use donor advised funds at Fidelity, stuff has to transfer, right? Which means their signatures have to happen. And when there's a lot of stuff moving and there's a lot of paperwork happening at either end, the earlier you get on this, the more likely it is that it's going to happen before the end of the year. Again, your custodian's going to tell you if you get this in by this date, we're going to guarantee it's going to happen, or we're going to do our very, very best. If you get it in after, we're still going to do our best, but we can't guarantee that it's going to happen by the end of the year. So I don't have like you always have to do it by this time, but my mantra is always the earlier you can do this, the better you are, the less stress you're going to have over the last 2 weeks of the year. And your clients need time to think about this, right? If you are just bringing the concept of a donor advised fund to somebody for the very first time on December 15th, the likelihood that you're going to get this done by the end of the year, pretty low. But you by now probably have a good idea of what your client income picture is going to be. And you probably have a good idea of what their charitable, at least intent is, if not their history, right? So these conversations, we want to have these conversations earlier in the year. The way I always told myself, I'm priming my clients for a decision. So I'm talking to them about this in March, April, May, June. And I'm even telling them, you don't need to decide right now. I'm just telling you about this now so that when I talk to you again about it in September, October, it's not the first time you're hearing about this. So I think those kind of how we communicate these things go a long way beyond just the what is the thing that we're doing, right? The last part that I'll touch on before we kind of jump specifically into Holistiplan is this concept of gain harvesting. So again, we talked about loss harvesting. I think folks are familiar with that. But I think gain harvesting is one. It's becoming more and more acceptable as a strategy as people are, figuring out how do we still add value to clients. But in order to do this, it's critical to understand how taxes work and how income is stacked on top of each other when the IRS is figuring out how much your taxes are. The brackets that we're accustomed to 10, 12, 22, 24, and so on, those are all applicable to ordinary income. Ordinary income is what left over when you start with taxable income and you strip away qualified dividends and long term capital gains, right? That's the amount that's subject to ordinary income tax brackets. Your qualified dividends and long term capital gains are stacked On top of that, when you're determining your taxable income, and the taxation of long-term capital gains and qualified dividends is dependent on the amount of taxable income you have. So we always think about this in terms of tax brackets for ordinary income, but capital gains have tax brackets too, 0, 15, and 20%. The 0% tax bracket for long-term capital gains and qualified dividends for a married filing joint couple in 2023 goes all the way up until about $83,000 of taxable income. So if you have $83,000 of taxable income or less, any component of that that is long-term capital gains or qualified dividends gets taxed at a rate of 0. Like, again, that's free money. Conceptually, if you had $100,000 of taxable income and it was all long-term capital gains and you're a married filing joint couple, your tax bill is 0, right? Because your standard deduction is going to take you below that $83,000 threshold and you're in that 0% bucket. Now, that's probably not going to happen for very many folks. But if you are looking at somebody and their taxable income is coming in at a low dollar amount, that's your opportunity to kind of step in and be a tax planning hero and say, like, look, you're going to think I'm crazy. But if we realize in this example, maybe you were projecting only $10,000 of dividends, like we're going to realize we're going to sell stuff and actually take a gain of $25,000. And it's not going to change your federal tax bill one bit. That's cool stuff, right? That's balloon dropping stuff. Now, balloons aren't actually going to drop, and your clients might not think it's as cool as you do. But this is one of those long term things where even if they don't need the money, you're just resetting their cost basis at a higher level so that the future growth of it is going to be subject to even less tax now, right? There's no wash sale rule for realizing gains like there is when you realize losses. So this can be a really valuable long term component, realizing gains. Now, there's a flip side to this, which is we still need to be aware of where that line starts and stops for the 0% bracket and the 15% bracket. And I'll show you how we can illustrate this inside of Holistiplan when you're conceptually trying to think about these things. But what that means is that because the long-term capital gains and qualified dividends sit on top of ordinary income, if you do something that doesn't change those pieces, but does change ordinary income, like a Roth conversion, you need to be mindful that you are now pushing money out of a 0% bracket and into a 15% bracket. And that has tax consequences. Really, really powerful. So, like, if you think you're doing something for somebody in the 12% marginal bracket, the tax rate that you're going to pay if you're displacing stuff from 0 to 15 isn't just 12, it's 12 plus 15. It's actually a 27% effective rate, right? So that doesn't mean it's bad, but it does mean it can come as a surprise to somebody who's not expecting it. So better to know that ahead of time and plan for it ahead of time. So I think with that, what I'm going to do is I'm going to jump into the Holistiplan product and just walk through how folks can do and think about and conceptualize or visualize some of these things. So we are inside our scenario analysis tool. If you've uploaded a tax return to this household, the first column is actually going to be already pre-filled with their 2022 year stuff. So that if we wanted to just create a brand new scenario and make a broad assumption, but still probably okay, that last year and this year are going to look roughly the same, we can do that really easily. So I've just added a scenario, and in doing so, I'm going to just change my title here to tax year 2023, change my year from 22 to 23. And if I wanted to, I could go through this and make other adjustments. I'm not going to worry about that right now. Maybe this year I've said, okay, last year I had a $5,000 loss carry forward. I'm going to assume that I still have that, but everything else is going to change. Maybe my social security benefits went up just a little bit. So I'll give these people a little bit more of a cost of living adjustment. But other than that, I'm going to keep it relatively the same. So what I'm looking at here is a retired couple who is collecting social security, but isn't yet taking IRA distributions. And we've intentionally made it this way because if you look at it, this is a pretty low income individual. They've got a little bit of rental income, but all told, they are in the 10% bracket for marginal for ordinary income. Their effective rate is just 1.3%. Like, this is super tax efficient. They're not paying very much in taxes and all. And I think, understandably, many folks would look at this and say, this is a really good, or this is a potential Roth conversion situation. These are folks that are in a low tax bracket. I can take money out of their traditional IRA, pay taxes on it now, get it into a Roth for tax-free growth, right? We're in that maybe those magical years of, yeah, we're taking Social Security, but we're not yet taking required minimum distribution. The challenge becomes, well, how much of a conversion do I do? Right? That's where all of these conversations end up going. How much of a conversion should I do? Many tax planning programs make this an iterative process where you say, I'm going to convert 5,000, 10,000, $15,000, and you get a whole bunch of outcomes and you try to pick the right one. That's a little silly when a computer can basically do all that work for you and show you what those outcomes would be at any level of Roth conversion. So inside of Holistiplan, there is a tool that we call Range Calc, which if we click on it in any scenario, will allow us to see visually the tax impact of adding increment of $1,000 of ordinary income, which is what a Roth conversion is, right? It's going to be taxable as ordinary income, and then seeing not just the marginal bracket, but the total effective federal rate that we would pay with each increment of additional of $1,000 increments. Off the top, right away, you can see a few things that might not have been otherwise readily visible if you were just thinking about marginal brackets. The first one is this little purple section. What's happening here, if we were to look back at this, we could see that of this gross Social Security, less than half of it is actually a taxable benefit. That has to do with the math of how Social Security benefits are taxed, right? We're led to think that it's always 85% of your benefit is subject to tax. That's not always true, right? There's actually math that goes on to determining how much is taxable. But we then have to be at least aware that as we add income to this picture, more and more of the benefit might be subject to tax. And you can see that visually here. So, yes, if we do a $1,000 Roth conversion, we have to pay tax on that $1,000, but we've now subjected more Social Security to tax. So, our effective rate's actually about 18.5%. Then we get to a spot where we've added so much income that 85% of our benefits are taxable, which is as most as it could be. So adding more income past that point won't subject any more Social Security benefits to tax. But we then get to this red section. This red section is what we were talking about before, where we've now pushed income up so high that we're displacing money from the 0% bucket for qualified dividends and long-term capital gains into the 15% bucket. So that if we're doing Roth conversions in this zone, we need to be aware that we're not looking at a 12% rate because that's what our marginal bracket is, but again, a 27% rate. There's other stuff as you go further out, we've got vertical lines here that show you if you do a dollar past this vertical line, you are now subjecting your client to additional Medicare taxes, right? Maybe you don't want to do that. So, we try to put these blockers in place. We were talking too, remember about the, gain harvesting. You could do the same sort of thing. So the top shows you increments of $1,000 of ordinary income. The bottom shows you the $1,000 increments of capital gains, where for some stretch, we're not actually subjecting our clients to any capital gains taxes, but we are making more Social Security subject to taxation. But you're actually not paying that 15% rate on capital gains themselves until you hit about $49,000 of capital gains. So without having to do a whole bunch of scenarios inside the tool, you can just visually see if this is what I was focused on, I can now go back and just enter $47,000 of long-term capital gains and actually show my client that doing that isn't going to have as big of a tax impact as they might think. So let's just look at that, what that might be. I'm going to make a copy of this same scenario. And instead of a $5,000 capital loss, I'm going to have a $40,000 capital gain. I can easily toggle between these two scenarios and see this little change icon. So if you didn't see that because it was a little quick, in between these columns, there's a little delta, a little triangle. And if I click on that, it's going to show me anything that's different between the column on the left and the column on the right. Anything that's in green means the column on the right is a little bit higher than the column on the left. So by adding this basically a $45,000 capital gain switch, the actual impact on my tax is only $2,500, right? That's not all that big of a deal. And all of that was due to more Social Security being taxed than otherwise were, right? That's a pretty big difference, right? $64,000 of income difference, but only $2,500 of tax. Like, that's pretty good. It's not a bad deal at all.
Not
You
at
do
all.
the same thing for a Roth conversion. I want to spend just one more section just walking through how folks can do, model QCDs and donor advised funds, and then maybe we can spend a little bit of time on questions there, if that's okay.
Yeah, absolutely. And I just kind of wanted to remind everybody that if you do have questions or comments, please add them to the chat and we will address them here shortly.
Absolutely. So working within, and I'll delete this scenario out so that it is not getting in our way. If we wanted to talk to our clients about a Roth conversion, maybe we looked at that tool and we said, yeah, I'm okay doing a conversion and moving things up, but I don't want to subject any of my long-term capital gains or qualified dividends to this 15% rate. So maybe I'll do a Roth conversion of about $45,000. I can enter a Roth conversion here for my taxpayer one of $45,000. And within just this screen, what Holistiplan will tell you is doing that's going to create an incremental cost of 7,300 bucks. What we're doing is we're doing a tax calculation with and without the conversion. Since the conversion is the only thing that's happening that's different between the two, we can say that's a $7,300 incremental cost. Here's where you have to, put on your client communication hat, right? Because you're saying, I'm making you pay $7,300 more in taxes than you otherwise would. Why would I be doing that? Well, maybe it's because when this money's going to have to come out in, say, 5 or 6 years, I actually think you're going to be in an even higher bracket. You're going to have to pay even more taxes if we waited. So at least, yes, we have to have a cost of this conversion, but we're doing it strategically. And all you're doing here is just giving people a heads up. Hey, your tax bill is going to be higher, right? Let's look at the donor advised fund situation and the QCD situation. So in a world, let's say where these folks maybe had, maybe they were over the age of RMD and they had like a $70,000 taxable distribution. If you wanted to say, what if we did half of that as a QCD and half of that as an actual taxable distribution? You could break out the taxable distribution to $35,000, do a $35,000 qualified charitable distribution down below. And again, in here, without doing anything else, Holistiplan will tell you, here's your savings versus just taking the total distribution, right? So $70,000. Just by doing it this way, you're saving 7,100 bucks, right? It's a pretty good deal. If you were to take the savings out and then donate, right? So donate the same dollar amount, this is actually still producing $684 more of tax savings than taking an additional $35,000 out and then writing a $35,000 check to charity. Right. So we're just showing you this right here within the screen. The last piece then would be if you wanted to model a donor advised fund contribution, you can do that too, just by going down to the Schedule A deductions, finding the charitable contribution piece and highlighting here. Um, I always take a break here just to say charitable contributions aren't always deductible. It's going to be dependent on what you're giving and who you're giving it to. So what you're giving could be cash, could be appreciated securities, or the ever popular non-cash, non-capital gains. That's like if you're donating your car to public radio. So what you're giving and who you're giving it to can determine sometimes how much of a deduction you can take because it's going to be based on as a percentage of your adjusted gross income. If you don't know that and you make a big charitable contribution and assuming the whole thing is going to be deductible, you might be in for an unpleasant surprise. So, as an example, let's say that these folks wanted to give $100,000 of cash to the United Way. Well, we put cash donated to a what's called a 50% limit organization. Of course, the IRS makes things hyper complicated. A 50% limit organization is going to be any public charity. So as long as you're not giving to like a private fraternal organization or something like that, we can assume we're thinking about what's called a 50% limit organization. But watch what happens if we try to put in a $100,000 charitable gift. We can't do it because our contribution is limited to just 60% of our adjusted gross income. So we can take a $30,000 contribution because this is a low income individual and we get to carry forward, almost $69,000 to a future year. But without these sorts of heads up, you might be in for a different outcome than you might have otherwise thought. A donor advised fund, again, that's going to be a 50% limit organization. So you would just say, what are you giving? Cash or usually capital gain stuff. You put that in here. Holistiplan will calculate the contribution for you, and then you can have a really good scenario there. So I think with that, Sarah, that's a lot of me talking more than most folks care to listen to in any one stretch of time. I don't know if anybody, posted comments or questions that came in, but I think there's still plenty of time to talk through those if they have them.
Yeah, absolutely. It doesn't look like we have anything in the chat at this point. But I mean, I can definitely see the value of having these concrete numbers to talk with your clients instead of just kind of a theory. Um, you can clearly see, the cost or the benefit of the decisions you're presenting. with a lot more clarity.
Yeah. I think too, sometimes folks get a little scared of some of this stuff, which is understandable, especially if you've never, touched tax projection stuff before. We jump into this because, part of this conversation is, hey, can you actually show the dollar outcome of some of these things? But I would say for folks who are either just starting or have never used Holistiplan before, don't let this stuff intimidate you, right? There is way more value that you can get without even getting into the tool, just by looking at, we mentioned, hey, what's the outcome? What's the output? If you uploaded these clients' tax returns, this is the report that you get, right? It shows you key figures, shows you where the breakdown was in terms of marginal brackets for ordinary income and long-term capital gains, shows you where folks might line up for a series of different planning opportunities, credits, taxes, what have you, that are based on modified adjusted gross income. We'll spit out where were the Schedule B income sources, which I always love, right? As a practicing advisor, if I have new folks in, uh, this is like putting on your detective hat, right? They might not have told me that they have these accounts, but their tax return is going to tell me that they have these accounts, both for interest and dividends, right? So there's all sorts of really cool stuff that you can pull as discussion points, just coming out of uploading somebody's tax return, which is always where we encourage people start there. There are going to be some quick, easy wins that you can do just by uploading a tax return, not even worrying about the projection piece. But if you want to take that step into the projection piece swimming pool, we've got it there in a pretty robust way for you too.
Yeah, absolutely. Well, with that, I mean, like I said, not a lot of questions out there today. Sounds like you got it all covered. There wasn't a lot of room for any questions to be left. So want to thank Ben so much for his time today. Really appreciate this outline. Like I said, I think it was very extensive and helpful. Look forward to the idea of possibly, reconvening next year to go through a full year timeline and seeing what resources we can put together there. So
Absolutely. Be happy to do that.
yeah, awesome. Well, thanks so much, Ben, and thanks everyone for joining. I'm sure we will have some follow up information and a recording of the webinar to share with those attendees that were unable to actually join today. So, thanks so much.
Thank you for having me. It's a pleasure being here.